This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
F4, page 107, chapter 16, Company Law Illegalities. A number of illegalities, a number of illegal activities affect us in F4. The first that's mentioned is wrongful trading. It actually goes hand in hand with fraudulent trading. The two are known together as fraudulent and wrongful trading. The previous law was extended by the Insolvency Act of 1986, and previously directors could only be liable for company debts where they were guilty of fraudulent trading, but fraudulent trading is difficult to prove. Just let me remind you that fraudulent trading is setting up or continuing to run a company with a specific intention of defrauding your creditors. Now, that was an awkward and difficult thing for any liquidator to establish. So the extension came in 1986 to create another offence called wrongful trading. And this gave creditors increased protection. And wrongful trading is where the directors or those in charge allow the company to continue to trade without there being reasonable cause to believe that the company will be able to avoid an insolvent liquidation in the foreseeable future. This is an example of the court being prepared to lift the veil. A company, as it enters into a transaction, surely it's right that the company is the creditor and the company owes the other suppliers money. This being the case, why then should directors be held personally liable? The answer is because the company doesn't make its own decisions. Company decisions are made by those in charge of running the company. So directors, and sometimes other people who are knowingly a participant in this, may be held liable where, for instance, the company has commenced an insolvent liquidation, and these people knew, or they should have known, that this was probable, and they held a position of power, typically a director. Now, a liquidator will apply to the court and allege that those in control should be found guilty of wrongful trading, maybe even worse, fraudulent trading, but certainly will allege that they were guilty of wrongful trading, and the court may determine that in fact yes they are, and then they can allocate a financial penalty against the directors individually and in aggregate. So the court will then look at the competences of these individual directors, and the case re Brazilian rubber plantations and estates is a fine example where two of the directors were excused from liability, whereas the other two should have known better and they faced financial penalties. Directors may escape liability if they can show the court that they took every step necessary to minimise or mitigate the creditor's potential loss. The second example of the illegalities is money laundering. This is a process where the proceeds of criminal activity are converted into assets appearing to have a legitimate origin. Their money is washed. Typical would be money arising from drug activities or other illegal activity. And the money is, this illegal money, is washed and washed and washed again until eventually it has the appearance of being from a legitimate source. The three distinct phases in money laundering is the placement of the funds into a legitimate business activity, now the transfer of money from business to business, place to place, bank account to bank account, moving it around the world, from country to country, and then finally integration, bringing the money back in. It takes on the appearance of having come from a legitimate source. It intrigues me because if you're seeking to avoid tax, then surely the reintroduction of the cash, in order that you then pay tax on it, defeats the object. The only reason I can imagine why people would money launder would therefore be to wash money illegally received from an illegal activity like drug dealing. Proceeds of Crime Act 2002 seeks to control money laundering by the creation of 3 categories of criminal activity. We're looking at laundering, failure to report, and tipping off. You'll notice that failure to report has got a maximum of 5 years in prison, and tipping off has a maximum of 5 years in prison. And I'm reminded of the Company Directors Disqualification Act, which carries penalties of one offence has got a 15-year penalty, another one's got 5, another 5, another 5. And it seems to me that without trying to remember these periods of maximum imprisonment, if it were me in the exam, I would generalise it and say the penalty is a maximum of 5 years. All right, if it's laundering and it's a maximum of 14 years in prison and or a fine, okay, you've got it wrong. But I cannot believe that the examiner is desperately interested in you knowing what is the maximum prison sentence that a person can face if they're found guilty of money laundering. If it were me, I think I would simply learn that both for CDDA, the Company Directors Disqualification Act, and for money laundering under Proceeds of Crime Act, I think I would just remember 5 years. Laundering itself is obviously a 14-year prison and or fine. Failure to report is a maximum of 5 years under fine, and tipping off. The offence of failure to report relates only to individuals acting in the course of business. So if you as an auditor or as an accountant became aware that your client was potentially involved in money laundering and you failed to report it, then you yourself are guilty. This could involve him 5 years in prison. So it seems to me that it actually isn't worthwhile. Of course, it never is worthwhile protecting a client who's involved in an illegal activity. But tipping off is also interesting, because if you tell your client and say, listen, I think you're guilty of money laundering, and without running the risk, therefore, of me being guilty for failure to report, what I'm going to do is notify the relevant authorities. Now, that statement in itself is also a criminal act. You are tipping off your client. You're telling your client that you're going to report him to the relevant authorities. And by telling him in advance, you're forewarning him, and the client can then take evasive action in terms of emigrating to some country, taking his proceeds with him to some country which doesn't have an extradition treaty with the United Kingdom, and you have enabled your client to escape the proper clutches of the law. So tipping off, if you're found guilty of that offence, then you yourself face 5 years in prison. That's an irony. Your client is relaxing somewhere with his gin and tonic or his vitamin drink in the sunshine and warmth, and you're sitting in prison because you told your client that you were going to notify the authority. The third one is insider dealing. And an insider is described and defined as a person who has a business connection with a company, as a result of which they may acquire relevant information, or they may be expected to acquire relevant information. Dealing is buying or selling shares or securities, and notice that dealing does not include a non-deal. So if I'm an insider and I don't have shares in the company, and I realize that the company has got some bad news coming and the share price is likely to fall, why is it not an offence for me not to buy those shares? Surely I'm using that inside knowledge in order to avoid a loss. And equally, if I do own shares in a company and I find out that there's some good news around the corner and the share price is likely to increase dramatically, why is it not an offence for me not to sell those shares? Because by not selling, am I not using my inside knowledge to make a profit? The offence of insider dealing is where, as an insider, you are guilty of dealing. It's not where, as an insider, you are guilty of not dealing. Dealing is buying or selling shares or securities in the company. The insider who has this relevant information, the relevant information must qualify as being unpublished, price-sensitive information. Unpublished means it's not yet in the public domain. Price-sensitive involves the fact that it is still less than 6 months old, but also it's price-sensitive if you have reason to believe that on publication this information is likely to have a material impact on the price of the affected securities. It intrigues me that whenever I have held shares in the past, I held one set of shares and the results were announced and they'd made record profits, and they announced a 1-for-1 bonus issue, and they announced also an increased dividend, and the market price of those shares fell. And I phoned my broker, my stockbroker, and said, what's happening here? They've got superb results and a 1-for-1 bonus issue, and there's an increased dividend, and yet the share price has fallen. And he said, well, yes, but the market was looking for even better. They were looking for profits not up 10%, they were looking for profits up 30%. They wanted a 2-for-1 bonus issue, and suddenly you got a 1-for-1. They wanted a dividend, which was twice last year, instead of just a 50% increase. So the market had anticipated even better results, and as a result, therefore, on publication, the share price fell. Now, coming back to insider dealing, price-sensitive information is information which you believe, on publication, is likely to have a material impact on the market price of the affected securities. I don't know. How can anyone tell? So, getting back to the notes, an insider in possession of unpublished price-sensitive information should not deal. That would be an offence. But equally, it would be an offence to the insider to encourage somebody else to deal. Encourage them and say, I think you should buy some shares in this particular company. And maybe not even saying that it's likely that there will be an announcement in the near future and the share price is likely to increase. They don't need to say that. If the other person to whom they are talking has reason to believe that the communicator is an insider, then not only is the communicator guilty of a second offence of communication, but also there is a third offence, and that is a person who does deal having received information from a person who they believe to be an insider. The information should be specific, not general. If the communicator says, I think you should get out of shares and buy loan stock or buy preference shares or just invest in commodities like gold or coffee, if it's general information like that which suggests that you should be selling your shares, that wouldn't count as inside information. That wouldn't count as being the communication of price-sensitive information. It's just a general comment. Disclosure of inside information other than in the proper course of employment to an authorised person is an offence, but there are some defences available to be claimed. For instance, if you can show that you are an insider, you had unpublished price-sensitive information, you did have some shares, but now you've sold them and 3 days later the share price falls, are you guilty? Well, no, not necessarily. If you can show that you were motivated to sell those shares by external factors, maybe your wife or husband has demanded that you have new carpets throughout the house, so you sell the shares to finance the purchase of new carpets. Now the court may turn around and say, well, did you in fact buy new carpets? And you may have to turn around and say, well, no, I didn't. We're still looking for one that we like, but at least we have the money available. Another defence would be that you had no reason to think that the publication of this unpublished information would have a material impact on the market price of the securities. There was actually a case reported on the BBC about 4 or 5 months ago now, where the barrister of a company, the legal representative of a company, was involved in takeover talks on behalf of the company, and on the Friday he contacted his father-in-law and said, "I think you should be buying shares in this company." Well, the father-in-law was too late on the Friday, and the following Monday was a bank holiday. The announcement was due on Tuesday. But the father-in-law managed to get in touch with the bank manager and arrange a loan, and first thing on Tuesday morning he acquired the shares. Later on Tuesday, the announcement came through and the share price shot up. The figure of profit that the father-in-law made, let's say it was 52,160. So he sold the shares, making this profit of 52,160. And then, bless him, he wrote a cheque, a payment order, in favour of his son-in-law, the barrister, for exactly half that profit, £26,080, and paid it into the son-in-law's account. Now, it's common practice in the event of a takeover and rapid change in the share price of a share, it's common practice that an investigation will be carried out either by the financial services authorities or by the stock exchange, or even by an appointed firm of accountants, to look into any unusual share transactions shortly before and or shortly after the announcement. And they found this man, whose name they didn't recognize. They found this man who'd bought and sold shares within one day and made 52,160 profit. So they investigated him. And he has to give full information, and the information that he gave was that he'd paid £26,080, exactly half the profit that he made on the share deal. He paid exactly half into his son-in-law's account. Both he and the son-in-law are now in prison, and I think it's safe to say that the barrister is likely to lose his law qualification. It really isn't worthwhile being a criminal. I remember as a trainee accountant I was involved in the stock count of a bank. Can you imagine? A team of us working on Saturday morning, locked into the vault of a bank, counting cash, counting packets of notes which had been wrapped up by the Bank of England and sealed by the Bank of England. How easy would it have been just to slip one of those packets into your pocket? Nobody checked our pockets as we went in nor as we came out. It would have been so easy just to... And then you think, come on, it just is not worth it. It cannot be worth it. If you're caught, you're no longer an accountant. You're not fit to be an accountant. You lose your qualification, you lose your credibility, you lose your honour, you probably lose your freedom and go to prison. It just is not worth being a criminal. Okay, so that will complete then illegalities on company law.